Good afternoon, everyone, and thank you for joining. My name is Caroline Seymour, and I'll be hosting today's webinar along with our owners, which is Stephen Gokes and his business partner, Brett Nelson. It's great to see plenty of existing investors on the call today, together with new people who are looking to learn more about Natgen and specifically the Natgen Development Trust PR25. The presentation will run for about 20 minutes and allow for 10 minutes of question time at the end. Down the bottom of your screen, you'll see a Q&A button. So please, as we go, put any questions you've got there. We can answer them along the way as well. This presentation today does not constitute financial advice. Before making a decision, you do need to read the information memorandum in its entirety and seek advice from your accountant or other professional advisor. It's available to wholesale investors only. I'll hand over to Brett now, who will give an overview of Natgen.
Thank you, Caroline, and thank you to everyone who has taken some time out of their day to join our PR25 webinar today. It's great to see so many people online. Natgen was founded in 2019 by Stephen and I with the aim to provide investors consistent monthly income and capital growth through purchasing or building commercial property. Our focus has been helping new investors find value in commercial property, as well as helping existing commercial property investors diversify their portfolios with the access to the various types of asset classes Natgen offers. On the screen, you can see an example of one of our development trusts. Sorry, Steve, previous slide.
Sorry.
Natgen Development Trust UC22. This asset is a large-scale self-storage facility we have built along the M1, which runs between Brisbane and the Gold Coast. This asset is now in its let-up phase. It's very similar to the PR25 Development Trust, which we'll be talking about today. Since 2019, Natgen has grown to a touch under $250 million of property under management, made up of about 18 different investment vehicles. We've purchased almost $50 million of commercial property in the last 12 months. And I specifically mention this point as for those of you who have been following Natgen for a while, would have noticed that we didn't purchase any freestanding commercial property assets in 2023. I like mentioning this because it demonstrates our Natgen investment philosophy of only purchasing property when we believe we can find real value for our investors. So basically, we don't just take something into a fund because it appears and it's there and we need to do it. We have a very specific strategy for what we buy for our investment funds. And our team looks at hundreds of assets every year to find the 4 or 5 or 6 that we eventually decide to purchase. Next slide. The first product that we offer is our Natgen Investment Trust, which mainly focuses on providing regular monthly income to its investors. This is where we target an existing already built asset, acquire it, and then operate it for investors to provide them with steady, ongoing, regular monthly income, which we pay into their bank account. These trusts normally operate for a 5 to 6 year term, and we sort of target a distribution rate of 8%, and we pay that monthly. The second limb of our investment is the Natgen Development Trust, part of which we'll be talking about today. This is where we find a development site, put together a development project, and build it with the help of investor funds. In fact, we kind of think we're pretty unique because in these types of investment vehicles, the investors effectively stand in the shoes of the developer and hopefully earn the development profits. We have 2 types of development trusts, short and long term. The short-term trusts normally run for about 2 years and offer a targeted return of about 25%. The longer-term trusts, which is where we build an asset, retain it, manage it, and hopefully pay distributions for a period of time, and then sell it sort of 5 to 6 years after completion. In these types of trusts, the development profit is actually built into the unit price on completion, and then only realised in the future once the asset is sold and funds are returned to investors, receiving distributions hopefully along the way. PR25, which we'll be talking about shortly, is an example of one of our long-term development trusts. Through Natgen Property Trusts, investors gain access to 3 forms of return. Firstly, you have the obvious one, which is the regular monthly distributions, which are made up of the net income generated of the property, and physically gets paid into investors' bank accounts each month. Secondly, you have the potential for the investment property or development project to hopefully have a capital gain at the end of the investment term. And that is obviously paid and distributed back to investors once the asset is sold. And the third is the taxation benefit, which investors receive through non-cash deductions. These are slightly more complex to understand, but essentially, investors receive tax deductions for expenses which are not physically paid. And an example of this for those of you who own commercial property or even residential property is a capital works depreciation deduction that you get every year. I'll now hand over to Stephen to continue. Thank you.
Thanks, Brett, and welcome everybody. I'd like to start with a peremptory apology. They've let me in charge of the slides today, and you've probably already seen that can be a little bit dangerous. It hasn't happened before and may never happen again. But in any event, I'd like to talk to you today about the property market in general, the commercial property market, and what we're seeing in terms of that and how we're responding to that. For those of you who've been to our webinars before, we always show this slide, which shows some important aspects of commercial property. You'll see that there's purple bars, which are the income returns of this is institutional grade commercial property across Australia. This is basically anything that's institutionally owned. So you'll see that the regularity of income is very significant, no matter whether it's a property upturn or a downturn. And the green bars are then basically the times when, as a whole, the property industry is growing in value or reducing in value. And you can see that the old adage of time heals all wounds in property applies here, because the area of the green above the line is much bigger than the area of the green below the line, and that's growth over time. And you can also see the cyclical nature of property, because there's basically three dips since 1986, so nearly 40 years, and those are times of significant shocks. One was the 1990s recession we had to have. One was the global financial crisis, and the most recent one, which shows in this as two dips, is basically COVID, which of course depressed property prices to begin with in 2020, and then in 2023, 24, we saw the upshot of that when work from home depressed prices of office assets pretty substantially. So that's the whole market. But if we then move on to what we like to do and where we play, is we're looking for mispriced commercial assets. In other words, places where the market price of something is within that broader thing that we saw before. We think they've got the pricing wrong. And of course, we're looking for mispriced assets that are underpriced, not overpriced, obviously. And that's where we always choose our areas to be looking in. And those of you, again, who've been around for a fair while will have heard me banging on for literally for years about the various things we look for: regional convenience retail, non-CBD office assets, industrial assets with rental reversion opportunities, some types of specialist assets like medical in particular, and of course development. And if you look at our portfolio on the whole, you'll find literally every one of those things is within our portfolio, except industrial assets with rental reversion opportunities, because they're a bit like hen's teeth. But I'm no quitter, so I'll keep looking for those as we go forwards. But property basically is informed by sociological factors. The value of property is really the value of where people want to be in conducting their lives. And I think work from home is a really good example of that people actually, after COVID, they worked from home a lot. That was concerning to office owners. But over time, it became clear that people are social animals, and they actually want to spend time in offices, interacting, learning, teaching, gossiping, and doing all those things that are very human in terms of how we interact. So basically those sociological factors are things that are linked to income resilience. But what's happening right now in Australia is really interesting, and it's related to a number of things, sort of countrywide, but also we'll talk then about Southeast Queensland and particularly this asset. But this slide's really interesting. I saw it at CBRE a couple of weeks ago, and it's their assessment of the needs, the property needs of each million people of population that are added. And as you can see, it's a lot of logistics and storage, 4.5 million square meters, 800,000 square meters of retail, 800,000 square meters of shops, crucially 420,000 households of residential, be that apartments or houses, large number of hotel rooms and a fairly large number of hospital beds nationwide. When you look at that and then you realize that in the last 4 years, we've added 2.5 million people to this country, mainly through immigration, you see both massive opportunity and some headaches for planners going forward. And the other thing to recognize about that level of, oh, excuse me, I've just moved on. That's just me being me again. When you add a lot of people to a community, whilst there's some cultural issues that we have to work through, and I think we're all aware of those types of things, in fact, there's a lot of productive capacity is added to the community too, because the people who come here as immigrants are pretty keen on bettering themselves and getting along better in life by and large. And they add massively to the productive capacity of the country. So if you look at 2.5 million people, logistics and storage, we need over 10 million square meters of extra space, which haven't been provided yet. And when we're working in a situation where there's limited supply because of the cost of new supply and the cost of building things, and the cost of labor in particular, you can see that the people who are getting into these areas of property right now are in the box seat for value adding in the future. And that ends up being basically the opportunity that we're talking about here. Since 2022, we've started a self-storage development business, which has up until now culminated in 2 large-scale self-storages being built in the growth areas of the Gold Coast. And they've both responded to these sociological and economic factors: high population growth, undersupply of storage in a high demand economy, limited competition because these things are actually large, they're capital intensive, so it's sort of moving into institutional type space, and of course the favorable demographics of what I said above, and also the fact that a lot of the areas we're looking at are places where people move household quite regularly, and that's important because one of the drivers of the actual use case for self-storage is people changing their household situation, moving from one rental property to another or one owned property to another, and as well as commercial considerations, which are increasing with micro warehousing businesses and small logistics businesses. So to give you an idea of that, I'm showing this slide, which is the cover of our information memorandum for PR25, and it's a really good indication of what we're talking about. The major growth area in Brisbane is towards the southwest, and that's because that's where a lot of land availability is. You can see Brisbane CBD in the background of that photograph, just in the middle. And this is sort of outer suburbs where land is cheaper, construction costs are somewhat compressed, and some of our issues with housing supply can be addressed relatively quickly and easily. And this massive growth area is something we're definitely looking for. So when we get to why this area, it's all about the middle figure here, which is a heat map of population growth in various local government areas and subsections. So the darker the red, the better. And Park Ridge is right in the middle of that specifically dark red area. So we can see the 2024 growth in population in those areas, which is basically in the sort of the box to the right in the left-hand side of that shows really significant population growth, which is continuing over time due to those economic factors. And if you look on the left, the catchment area, which has been identified by the valuers on the left-hand side, is right at ground zero of that dark red in the middle. So we're right in the middle of that population growth. The next thing that comes along in that to also prove that is that government starts to spend on infrastructure in these places. Whether population brings infrastructure or infrastructure brings population, it depends how good the planning's been. But in any event, we're right at the epicenter of a lot of infrastructure here as well. So you've got a massive expansion of the Logan Hospital. You've got the master plan communities of Yarrabilba and Flagstone, which are massive population growth areas. And you've got on a more local level, the Park Ridge Town Centre is a shopping centre that was probably built earlier than it was actually needed, but it's going to massively benefit from so many people coming into the area. So I guess that's kind of why Queensland, why Southeast Queensland, and why Park Ridge is the place to be specifically for this product. So I don't want to go into this too much. This is the return profile, which is probably best understood by reading the information memorandum specifically. But in the short, put shortly, the blue and the orange areas are where capital growth is occurring. That's during the blue construction period and the orange let-up period. And then the grey shows the cumulative returns on income as we go through the latter years of the trust. The timeline here indicates what we're expecting in terms of how long things will take. So effectively, we'll close the offer pretty soon. I think we said the 9th of October, if I remember correctly, Caroline. But I think we're nudging 85% subscribed now. So if you are looking to invest, I suggest you consider it as quickly as you possibly can, given the requirement that you fully understand the investment structure. So basically, we're settled aside in November. Up till February, then we'll take to do a detailed design and probably redesign what we've already got in the DA to improve it, which is an incident of every investment that we've done. What we've built in every Natgen development trust has always been an incremental uplift on what we said in the IM we were going to do, because the IM always, the information memorandum always shows kind of the base case that we can support at the time, and then we just keep making it better. It's an iterative process to improve the value for unit holders going forward. So then basically March 2026 to March 2027 is probably the building time, maybe April 2027. We refinance towards the end of that financial year and start the let-up period at the same time, June 2027, with the expectation that that let-up period will take approximately 2 years to get it full. And that's, going back to this slide, the end of the let up period is the peak of the orange section there. We're not the only people who've noticed self-storage as being a pretty good thing, and there's been a lot of global money flowing into Australian self-storage businesses over the last couple of years, which you may have noticed. That's because it's in Australia, it's stopped being sort of a mums and dads industry and is coalescing into larger institutional ownership. And I think we have pretensions of participating in that larger sort of ownership model through our investors investing in each specific asset. So that's hopefully gives you a bit of an overview of where we come from to do this and how we execute. And in terms of our execution, I'm just going to hand it over to Brett to talk about one of our previous projects. Thanks, Brett.
Thanks, Stephen. On the screen, you'll see a graph which shows the performance of our most recent self-storage development trust, which is the Natgen Development Trust UC22. Like I mentioned before, it's complete and in its let-up phase. I'm going to start by saying that these self-storage developments have a reasonably complex return profile. That's why, Stephen was obviously suggesting everyone read the IM and go through that. But I'll do my best to make this graph as clear as possible. So you can see the blue line, which represents the development phase of the investment. We did initially suggest this would take about 12 to 18 months, but we had a major delay with the council, with the person who were buying the land off with the underlying subdivision. And then following that, we had a lot of rain at the start of 2024. So that pushed out the development phase to just under 3 years. But the interesting part to look at is if you look at the actual increase of the unit price for the investors once the building was complete, you can see that the investors have gained a 70% return based off our latest valuation. This is far outperforms our initial expectations, which were 16% on the day it was completed and 42% once it was full. Given that we're in the let-up phase of this project, the sheds are currently being leased out right now by our managers. The investors will start receiving monthly distributions very soon, which will start small and increase over time as that building let-up increases. But the other important point to note is, currently based off our targets that we have at the moment, that cumulative return from where we were suggesting it would be 42.7 is now looking at over 100% at the end of that orange line there. On top of the monthly distribution, they will then start gaining, which will be above 10%. Again, understand these are kind of complex to understand, so anytime happy to have calls on it. Stephen and I can answer questions on this offline if anyone has any specific questions about that trust. Before I wrap up, I also thought it'd be worth mentioning our self-storage brand, General Self Storage. On the screen, you can actually see Gavin and Gary, who are our current managers at Coomera and Mollendina, our two facilities there. And the reason why I think it's important for people to understand that there was a few reasons why we decided to start our own brand. The first, instead of going with a national or a store local or a Storage King, and the first is obviously the fees that they charge, the setup fees and ongoing management fees. We've mandated a fee that's less than what they charge, allowing us to ensure that the net profit of the trust is as high as possible. And the second is the agreements which they make you sign, which we don't have with General Self Storage. And these agreements make it really hard when it comes to selling the asset with first right of refusal clauses and things like that. So with our General Self Storage brand, it allows us to be flexible when the time comes to dispose of these assets. And then the third and arguably most important reason is the localized marketing strategy. So self-storage, for those of you who are not aware, is a needs-based business, and people only obviously use it when they need it, which makes it marketing extremely important part of the business strategy. And having our own brand allows us to focus on our customers, which are usually within a 15-kilometer radius of the store. If you're partnered with a national brand, you contribute to a national marketing strategy, which they can use the money all around Australia, whereas with general storage, every dollar we spend on marketing, which is extremely important, goes, gets put towards targeting our customers within that 15-kilometre radius where all of our customers reside. And actually doing that, having that approach at our most recent facility at Coomera has really helped with the let up period early on. So over to you, Caroline, to wrap us up.
Thank you. As with all Natgen investments, and Stephen's spoken to a number of times, you do need to read the information memorandum in its entirety. If you don't have a copy, please reach out and we'll make sure you get one. The way to submit an application is via the Natgen investor portal, via the website at the top right-hand side. You can invest via individual names, self-managed super, family unit trusts. Speaking with your accountant again about structures important. And you do need to be a wholesale investor. On to the next slide, Stephen. Brett talked earlier about our portfolio of investment trusts with monthly income. They're also in the information memorandum, together with our short-term and long-term development trusts. We'll go to some questions that have come in now. And for those that came onto the call just after we started, down the bottom of your screen, there's a Q&A button. So if there's anything you'd like to ask, we'll go through people's questions now. And Stephen's just going to play a video of that self-storage facility at Upper Coomera that we've just completed and opened. Brett, you might like to talk to this one just around financing. What finance structures do we use between construction and then at the end of the project when it's complete and you're in the hold phase?
Yeah, easy, Caroline. So, financing with development financing, you can finance things through the bank when you can. That financing can be slightly cheaper, but a lot more harder to deal with. Otherwise, you can in the development phase, you can also go through second tier mortgage providers, which we have actually done with both our self-storage facilities. The rates are only slightly more expensive, and they're a lot easier to deal with. And given the term of the debt for the development is only staggering as it increases and not out for too long, we find that a better way to fund these developments. In saying that, once they have reached the completion and enter the let up phase, our previous two development self-storage facilities have been taken over by the Commonwealth Bank. They have also expressed interest in funding our future development, so we will wait to see what offers they provide us for that. So, development phase, there's a wide range of options. Let up phase, our number one option is to refinance it with the Big Four bank, and Commonwealth Bank seems to be the one that understands self-storage the most and offers the best terms. So it'll very likely be with CBA the time we open the doors.
Sure. Stephen, I might put this one to you. Will the fund run longer than 9 years? And if so, what would need to be put in place for that extension of time?
Okay, so the rules of how long the trust is in place are contained within the Constitution and also the what we say in the information memorandum. So in this case, we have basically the three phases: the construction phase, the let up phase, and then the operating phase. And our operating phase will be 5 years. At the end of the fifth year, we'll seek to sell the asset at the end of that 5-year term. During the sixth year, if there's some reason why we can't do it during that particular year, if there's economic circumstances or something where we feel like it's not the right time to sell for the benefit of the unit holders, we'll seek to extend it for up to 12 months. And we keep an as of right manager, basically opportunity to extend it for 12 months. Thereafter, the only way it could be extended further than that would be by unit holder vote. So it's unlikely to extend any further than after that first 12 months. But it's possible, and it's through a mechanism allowed for within the Constitution. I hope that answers the question, kind of.
Sure. We've got another one that's similar to that in as we approach the sale of the asset. Um, as we approach sale of the asset after 6 or so years to crystallize the capital growth for investors, do you sell to an open market or do you transfer to a related holding entity? And if so, how are returns calculated?
We haven't got that far to look at that. I think the expectation is that the base case would be to sell to a third party, and there's quite a liquid market in these, large scale institutional grade self-storage facilities. It's if perchance in the future, and we're talking a fairly long time in the future, that there was a good case for it to be sold to some form of related entity, then all our fiduciary obligations would be in play there to ensure that we treated all unit holders fairly and got third-party valuations and the like. It's the sort of thing that we kind of shy away from if we don't have to do it, if we don't have to have related party transactions, we seek not to. And if we do, we have to demonstrate value. And I think through the whole thing, our guiding principle is hopefully always demonstrably that we're looking for unit holder value. The other thing to be aware of is that within the Constitution, the manager, we always have the right to make a decision to sell the property early. And if we see an opportunity to exit these facilities at an earlier time, if let's say we get an unsolicited offer to purchase them earlier, once we do all the work to come to the conclusion that that's in the best interests of unit holders, we have the option to end the trust and to pay out the subscriptions and the capital profits at that stage as well.
Thank you. And then maybe for you, Brett, this one, can we expand a little bit on the tax impact of the distributions from a depreciation point of view, and what sort of percentage of distribution will be subject to income tax?
Yeah, that's easy, Caroline. So the percentage of distribution, a lot of it is determined by how new the asset is, and so what sort of fixtures and fittings and plants and equipment it has. So if you take sort of our previous assets like our office buildings and our relatively new IGA shopping centres, all of those have had 100% tax deferral for at least 2 or 3 years, and then it starts sort of tapering away to 90, 80, 70. And some of our older facilities, sort of around the 60 to 70 mark, and then start tapering away down to the low 50s and the 40s. Something like this with being a brand new facility, and the full capital works being calculated, it very likely will be 100% for a decent period of time. I would have thought at least 3 to 4 to 5 years. That will be a very high tax deferral rate, and then after that, it'll start dropping. So exact percentages we can't give you until our quantity surveyors go through and give us the finalised depreciation schedule. But given the asset is brand new, I'm comfortable to say that it'll be very, very high for the first few years.
Sure. That looks like that's all the questions that we've got. So thank you everyone for your time today in listening to the presentation. Please reach out via phone call or via an email with any questions that you might have that you'd like to take offline. So thank you for attending.
Thanks, everyone.
Thanks, everyone.